Hi, this is Andy Hoffman, Media Director of Miles Franklin Precious Metals. It's Friday morning, April 18th, and with the markets closed, I'm a bit calmer than usual. That said, it was a very trying week as efforts to discredit precious metals amidst the most dangerous political and economic environment of most of our lifetimes have never been more blatant. The powers that be, as I call the heads of the major Western governments and banks that destroy billions of lives with money printing, are literally attempting to commandeer all financial markets in one of the most arrogant displays of financial hubris ever displayed. Stocks and bonds are supported by endless amounts of central bank printed liquidity, while less desirable markets, particularly precious metals, which act as the kryptonite to their fiat Ponzi scheme, are naked shorted into oblivion. More ominously, simple math dictates that the vast majority of supposed Western central bank gold reserves are gone, vacuumed up by Eastern central banks, institutions, and citizens alike, as said powers that be attempt to kick the can that last mile. When it comes to paper markets, it is conceivable this grand experiment in money printing lunacy will work, as conceivably the price of the Dow Jones propaganda average can be placed wherever the power that be desire. Of course, only in nominal terms, because ultimately the inflation they create will make such gains, if gains at all, become negative in real terms. But this is how an environment of record margin debt, PE ratios, and complacency has been fostered, and how hopelessly insolvent governments can sell sovereign bonds at record low yields despite surging debt, inflation, and social unrest. Can you imagine Italian government bond yields are trading at record lows after its third government failed in as many years and its economy is on the brink and there's riots in Rome because of all the homeless people? And better yet, per the title of today's audio blog, Death of a Market, I am still in shock from what I just read in learning that the benchmark Japanese 10-year government bond didn't trade a single bond over a 36-hour period this week, as no one would dream of buying them in an environment of surging inflation, debt, and money printing at a measly 60 basis point interest rate. However, no one will sell them either, let alone short them, knowing that under the ever-expanding Abenomics QE program, the Bank of Japan will literally buy everything in sight for at least the next year and likely indefinitely. However, physical markets, like gold and silver, are completely different animals, as the effect of suppressing prices too low is an utter collapse in production, which is what we are seeing now, and we'll see vastly more of in the coming years. Prices have now been below the cost of production for more than a year, and the impact on mining companies has been devastating. I mean, look at the massive write-offs and losses and cuts in capex that we've seen and mothballed properties. Gold production roughly peaked about a decade ago, and the outlook for the coming decade is catastrophic at a time when global demand has never been higher and increasing dramatically. Miles Franklin had its best week in some time this week, and as always, saw essentially zero clients selling. The US Mint is now on pace to sell 25% more Silver Eagles than last year's record level, and gold forward rates have gone negative for the 1, 2, 3, and 6-month periods for the first time ever. Negative gold forward rates indicate a broken market in which paper prices don't properly reflect tight physical demand. To wit, from January 1989 through July 2013, there were only 7 days observed in which there was a negative GOFO. But since July of 2013, it's been negative more than 55% of the time. And as I noted, now we're at the 6-month period where it's negative. In this context, the market for physical gold that can be delivered to the custody of the buyer has never been tighter. And thus, it's only a matter of time before this ill-fated game blows up in the cartel's face, just as the London Gold Pool did in 1968. This week, I wrote of what I call the New York Gold Pool, and how their blatant manipulations are setting up the global currency markets for an historic shock in the coming years, or perhaps sooner if things don't run as smoothly as they'd like. Some speculate the Chinese will unilaterally catalyze such an event by updating the world of its current gold holdings, which I wrote about yesterday. I believe they hold more than 10,000 tons of gold, and Koos Jansen, who's a leading expert in the field, believes it's more like 13,000. But I'd be quite shocked to see them say anything, despite the rumors spreading that they will say something this month on the 5th-year anniversary of their last update, which was when they said they had exactly 1,054 tons. That said, if the unprecedented tightness in physical supply indicated by the GOFO rates, and by physical supply I'm not referring to the availability of small amounts of coins that we could buy, but large amounts that the People's Bank of China would be seeking, anything could happen. As for this week's news, and I always say news in quotes, because markets are, there's so much propaganda around, and when markets move, it no longer is because of news, but manipulation. It's difficult to imagine a time when so many negative things were occurring simultaneously in so many different places. Not to mention the efforts utilized to counter the negative sentiment such events create by manipulating markets. On Tuesday alone, the US CPI was twice expectations. The Empire State Manufacturing Index unexpectedly plunged to negative territory, and the NAHB Housing Index remained at multi-year lows despite calls for a sharp rebound because of the weather and other factors. The mainstream media continues to spread its latest propaganda buzzword, de-escalation, when it comes to anything Ukraine related. But the fact is the situation has never been worse, with bloodshed increasing and an increasingly aggressive rhetoric. Better yet, and we're still talking about Tuesday, we learned that the Japanese government is about to dramatically reduce its economic outlook amidst an early, catastrophic response to the April 1st national sales tax increase. Retail sales have been reported to fall as much as 25 to 30%, and prices have increased by at least the amount of the 3% tax increase, which, by the way, will be increased another 2% next year. And this in a nation whose GDP was just reported to have grown by only 0.2% in the fourth quarter, amidst a 21st straight month of falling wages and a 5-year high in both the CPI and gasoline prices. China then joined the party by announcing much lower than expected GDP growth as well, setting the stage for further PBOC easing, as evidenced by the decline of the yuan this week to a new multi-year low. And finally, Whirly Bird Janet herself gave an extremely dovish speech, in so many words repeating Draghi's 2012 sentiments in claiming the Fed will do whatever it takes to save the U.S. economy. And given all that, the PPT managed to turn the plunging global equity markets around with a series of Hail Mary rallies. In fact, the big drop in the NASDAQ turned around literally when the rumor leaked that the Japanese government was going to lower its economic outlook and thus increase the outlook for more QE, which of course should be massively bullish for gold. But while they did it, they were tacking gold for as much as $35 in one day, and it came back to only be down 25 or so. And this is while oil surged to a new high for the year at nearly $105 a barrel. Look, such action will only serve to awaken more people to the reality the world faces and significantly increase physical gold and silver demand, as evidenced by the plunging GOFO rates immediately after Tuesday's gold and silver attack, which, by the way, fell on the 1-year anniversary of last year's April PM raids, which I lovingly call the alternative currencies destruction, because it happened to coincide also with the first major Bitcoin crash. In my view, this period last year was when the PM markets were permanently broken, as the gap between paper prices and physical supply and demand factors started to gain significant media attention. We wrote earlier this year of gold manipulation becoming increasingly mainstream news, and the more such silliness ensues, the more global investors will realize that the writing is on the wall for falling currencies and rising gold and silver prices for the years to come. Well, that's it for now, as I'm feeling a bit burned out in desperate need of a bit of R&R over the holiday weekend. So enjoy your Easter, Passover, or whatever you intend to celebrate. And as always, think long and hard of how best to prepare for the coming global currency crisis. And if you do decide to do something about it, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. There's a reason we've been around for 25 years with an A+ Better Business Bureau rating and not a single customer complaint, because we give the best service in the industry, competitive pricing, and we're always honest with you. And as always, you can contact me with any questions you might have at ahoffman@milesfranklin.com. Thanks very much.